Here's a number that stops people cold. When Americans are asked how much they think they'd need to retire comfortably, the answer keeps climbing. The latest figure, about $1.46 million. And here's the twist. The typical household in its early 60s has saved somewhere around $200,000. So either most of the country is doing retirement wrong, or the word comfortable is doing an enormous amount of hidden work. This is the economics of retiring comfortably in America. For most of American history, retirement wasn't really a thing. You worked until you couldn't, and then you leaned on your family, your farm, or whatever savings you'd scrape together. There was no comfortable version. There was just the end of work. Two big things changed that. First, in 1935, the government created Social Security, a public program that pays you a monthly check in old age, funded by taxes on today's workers. It was never meant to cover everything. It was designed as a floor, a way to keep older Americans out of outright poverty. Then came the company pension. For much of the 20th century, big employers promised workers a guaranteed monthly income for life after they retired. That's called a defined benefit plan. The company took on the risk and did the math. You just showed up, put in your years, and collected. For a while, this combination, Social Security plus a pension, actually delivered something you could call a comfortable retirement for a lot of middle-class workers. The floor and the pension stacked on top of each other. But that world quietly fell apart. Pensions became expensive and risky for companies to promise. So over the past 40 years, employers handed the job and the risk back to you. And that shift is the reason "how much do I need" became a question millions of people now lie awake asking. So what does comfortable actually cost? The honest answer is that it depends on the life you want. But we can put real numbers on it. Financial planners often use something called a replacement ratio. The idea is that in retirement, you don't need to replace all of your old income, just enough to keep your standard of living. Most estimates land somewhere between 70 and 80% of what you earned before you stopped working. Some of your old costs disappear. You're not commuting, you're not saving for retirement anymore, and maybe the mortgage is finally gone. Let's make that concrete. Say a household earned $80,000 a year before retiring. A common target would be somewhere around $60,000 a year to stay comfortable. Now here's where it gets interesting because that number has to come from somewhere. Social Security, on average, replaces only about 40% of a middle earner's pre-retirement income. The average retired worker's check is a little over $2,000 a month, call it $24,000 a year. That's the floor doing its job. But it's a floor, not a lifestyle. So for our $60,000 household, Social Security covers maybe $24,000 of it. That leaves a gap of around $36,000 a year that has to come out of savings every year for as long as you live. And how long is that? A 65-year-old today can easily live into their late 80s or beyond. So you might be funding that gap for 20, 25, even 30 years, which means comfortable isn't really a monthly number. It's a monthly number multiplied by a lifetime you can't predict. There's a rough rule of thumb planners use to translate savings into income. It's called the 4% rule. The idea is that you can pull about 4% of your savings in your first year of retirement, then adjust that amount for inflation and have a decent chance of not running out. Flip it around and it gets sobering. To safely generate that $36,000 gap, you'd need somewhere in the neighborhood of $900,000 saved. Not to live large, just to top up an average Social Security check to a solidly middle-class life. Stretch that $36,000 gap across a long retirement, add in rising prices, and you start to understand why the magic number people quote keeps drifting toward $1.5 million. It's not that anyone needs a mansion, it's that a modest, steady paycheck, guaranteed for decades, quietly costs a fortune to reproduce on your own. Now follow the money, because this is where the whole system shows itself. Remember that pension, the guaranteed check your grandparents' generation might have gotten? Most private sector workers don't get one anymore. In its place came the 401k and the Individual Retirement Account, or IRA. These are tax-advantaged accounts you fund yourself, usually out of your own paycheck, sometimes with a partial match from your employer. That's called a defined contribution plan. You put money in. What comes out at the end depends on how much you saved and how the markets behaved. This was a massive shift, and it moved trillions of dollars. When companies stopped promising pensions, they stopped carrying that long-term risk on their books. The obligation didn't vanish, it just moved on to you. And a whole industry grew up to manage the money on the way. And not everyone even gets a seat at the table. Whether you have a workplace plan at all depends heavily on your employer. And by some Federal Reserve-based counts, more than half of American households have no dedicated retirement account of any kind. The single biggest predictor of whether someone builds a nest egg often isn't discipline or willpower. It's whether their jobs signed them up for a plan in the first place. Here's the part worth understanding. Your retirement savings don't just sit in a vault. They're invested through fund managers, and those managers charge fees, usually a small percentage of everything you've saved, taken out every single year. A fee that sounds tiny, like 1%, quietly compounds. Over a working lifetime, a percentage point or two in fees can eat a meaningful slice of your final nest egg. You never write a check for it. It just gets skimmed off the top year after year. Then there's the advice layer. Financial advisors, planners, annuity salespeople, an entire economy built around the anxiety of that one question. Am I going to be okay? Some of that advice is genuinely valuable. Some of it is a product being sold with a comfortable retirement printed on the brochure. So the money flows like this. You earn it. You defer part of it into an account. The financial industry manages it and takes a steady cut along the way. And decades later, whatever's left is what you actually get to retire on. The system didn't just hand you the responsibility, it built a business on top of it. So who actually pays for a comfortable retirement? Overwhelmingly, you do. But let's break down the pieces because the mix matters enormously. Start with Social Security. For lower-income retirees, it might replace half or more of their old income. For higher earners, far less. On its own, for most people, it delivers survival, not comfort. That's by design. On top of that sits whatever you saved, your 401k, your IRA, any pension you were lucky enough to keep. This is the part that turns a bare-bones retirement into a comfortable one, and it's exactly the part that varies wildly from one household to the next. Then there's health care, and this is where a lot of people get blindsided. Medicare, the federal health insurance program for people 65 and older, is a genuine lifeline. But it doesn't cover everything. There are premiums, deductibles, and plenty it simply doesn't pay for. One widely cited estimate puts the average lifetime out-of-pocket health cost for a 65-year-old today at roughly $185,000 and for a couple, around $370,000. And that figure doesn't even include long-term care. Here's a distinction that trips people up constantly. Medicare is not Medicaid. Medicare is the insurance you earn by paying in during your working years. Medicaid is a separate program for people with very low income and few assets, and it's the one that actually pays for long nursing home stays, but only after you've spent down almost everything you have. And there's a payer the spreadsheets almost always leave out: family. When the money gets tight, unpaid relatives step in, driving to appointments, managing medications, giving up work hours to provide care that would cost a fortune on the open market. Economists have valued this kind of unpaid family caregiving in the hundreds of billions of dollars a year nationwide. It never shows up as a line item in anyone's retirement plan, but somebody is absolutely paying it. So the order of payment for most people looks like this. Social Security covers the floor. Your savings cover the comfort. Medicare covers a lot of your medical bills, but not all of them. And if the money runs out and you need serious long-term care, Medicaid catches you, only after your life savings are mostly gone. Now, for the costs that don't fit neatly on a spreadsheet, the ones that quietly decide whether comfortable stays comfortable. The first is inflation. A retirement income that feels generous at 65 can feel thin at 85. If prices roughly double over a couple of decades, which is well within the historical range, then a fixed pile of savings buys steadily less every year you live. Comfort has an expiration date if it isn't protected against rising prices. The second is healthcare inflation, which tends to run faster than everyday inflation. The medical bills that already eat into retirement don't just grow, they grow quicker than almost everything else in your budget. The third is what planners call sequence risk. If the stock market takes a bad fall in the first few years after you retire, While you're pulling money out, your savings can be permanently damaged in a way they wouldn't if the same crash hit later. Same average return, wildly different outcome, all because of timing you don't control. There's also the tax bill you may have forgotten you signed up for. Money in a traditional 401k or IRA was never taxed on the way in, which means it gets taxed on the way out. Most withdrawals in retirement count as income, so a real chunk of that balance you've been proudly watching grow was quietly always headed to the government. The number on your statement isn't quite the number you get to spend. Then there's longevity itself. Living a long life is a blessing that also happens to be expensive. The longer you live, the more years your money has to stretch, and the higher the odds you'll need help with daily living. And that's the big one hiding behind everything: long-term care. About 7 in 10 people turning 65 will need some form of it. A private room in a nursing home now runs around $130,000 a year. Medicare largely doesn't cover it. And for a lot of families, that single line item is what turns a comfortable retirement into a spent down one. So why is it built this way? Step back, and one theme explains almost all of it. Risk got moved. In the old model, the employer or the government carried the big uncertainties: how long you'd live, how markets would perform, how much care you'd need. In today's model, those uncertainties sit squarely on the individual. You are now your own pension fund manager, whether or not you ever wanted the job. That shift benefits some players clearly. Companies shed unpredictable, decades-long promises. The financial industry gained a vast, steady stream of fees, and the government limited its exposure to Social Security's basic floor. The risk didn't disappear, it just landed on the person least equipped to spread it, you. And the demographics make the pressure worse. The baby boomers are moving through retirement in enormous numbers. People are living longer, and there are fewer workers paying in behind them. Social Security's trust funds are projected to run short in the early 2030s, which could force benefit or tax changes down the line. It's worth noting that not every country does it this way. Some wealthy nations lean far more heavily on strong public pensions, spreading the risk across the whole society rather than household by household. That's not automatically better or worse. It's a different choice about who carries the weight, and America mostly chose you. So what does a comfortable American retirement really deliver, and for whom? Here's the honest read. The system works genuinely well for a specific group: people with steady, higher incomes, access to a good workplace plan, and the discipline and margin to save consistently for decades. For them, the tax-advantaged accounts and market growth can build a real, comfortable cushion. For everyone else, comfortable becomes a stretch goal that quietly shrinks. It bends into working a few more years, downsizing the house, leaning on adult children, or simply defining comfort down to match what the money allows. The uncomfortable truth is that a comfortable retirement in America has become less a reward for hard work and more a reflection of what kind of job you had and what plan it offered. The floor is public, the comfort is private, and the gap between them is where an entire anxious fee-collecting industry lives. Comfortable was never really about the money you spend. It was about who agreed to carry the risk of a long life. And in America, more and more, that's you. If this helped make sense of where the money actually goes, consider liking and subscribing. It's the simplest way to keep these breakdowns coming. Thanks for watching, and I'll see you in the next one.